Hello everyone and welcome back to our article review sessions, and today we have an article written by our editor Ijwari Sawant, and it's titled "The IMF, so the International Monetary Fund, introduces the Short-Term Debt Liquidity Line to redeem itself." The Short-Term Liquidity Line will be recurring throughout this whole video, so keep it in mind. Here's a fun fact that you might not know. In the past few months, a total of 103 countries out of the 189 member states of the world have approached the IMF to seek for a rescue loan. Look, and if that doesn't worry you, how about a predicted global GDP growth rate? So how much will the economy of the world grow next year? Well, that's going to be negative 3%. And if this wasn't enough, imagine $100 billion of portfolio outflows, which at the end of the day just means that money's leaving the emerging economies in the time span of 2 months. That's 3 times higher than in the 2 months after the global financial crisis in 2008. 3 times higher. I know that in times of the pandemic, we're all looking for positive news. But it's inevitable that an economic recession is coming, and the Great Depression might not seem that big.
But we've also seen countries become far more proactive with their economic policies. Central banks have already lowered their interest rates, and it is predicted that countries will be taking fiscal actions amounting to $8 trillion.
Just for reference, in the world there are about $80 trillion. That's roughly the estimated amount. So $8 trillion across the world, that's a fair amount of money. And although you might think, yes, governments have already dealt with economic recessions and everything just gets better in the end as time goes by, we have to take something into account. They've never had to deal with a global health crisis that affects every other country simultaneously. Generally, it's very easy to just request another country for some help, since they're not being affected by your crisis at the same time. But this is a pandemic that's affecting everyone equally. Moreover, the IMF has stated that even if lockdowns across the globe get lifted by roughly July of 2020 or August 2020, only a partial economic recovery can be expected for 2021.
But along with the countries, the IMF has also prepared to help countries that would need financial aid. The IMF has a lending capacity of $1 trillion, and this time it has also doubled its access to emergency facilities up to $100 billion. The institution has also revamped its catastrophe containment and relief trust to help 29 underdeveloped economies. Moreover, the G20 countries have also suspended the bilateral debt repayments, amounting to $12 billion from underdeveloped countries. A high level of international cooperation has been observed in the past few months because most countries, especially the developed nations, realize that they need a healthy global economy for themselves to stay afloat.
Now, a new measure that the IMF is taking after almost 10 years is something that will hopefully aim to relieve all of these struggling countries. And this is the idea of a short-term liquidity line. And this is what we said in the title. The idea behind this measure is that countries with strong policy frameworks who are facing short-term liquidity shortages, as well as a balance of payments needs, can approach the institution for loans. Short-term liquidity shortages mean that they do not have the money, but not because of their own fault. Now that would be insolvency problems. In that case, the IMF wouldn't be able to help. But because it's liquidity problems, then they are able to help. The loans will be extended for about a period of 12 months, which is something quite unique about this credit line. And it's that it has this revolving access. To define what revolving access might mean and how is this relevant for you, well, this matters. It's because it allows countries, those that borrow, to repurchase the loans and repay them during the first year duration to meet their short-term liquidity demands. A country that borrows from the IMF means it is endorsed by that institution. That in turn gives a signal to the global economic markets that it has a strong economic framework. And what does this mean? That they will get cheaper rates for their borrowing costs in the market. So when you issue debt, as a country, you want very low rates from the financial market. And how do you get that? Well, that only can happen if the financial markets have confidence that you, as a country, will be able to give the money back. And let's say that the IMF is backing you up. Well, that's a fair confidence boost for the financial markets that you will be able to give your money back. So they'll be giving you cheaper money.
Moreover, the short-term liquidity line can prevent insolvency due to liquidity shortages so that they don't require greater financing in the future. Currently, the estimated demand for SLL by countries is $50 billion. But if you're familiar with the IMF loaning mechanism, you're probably wondering, what's the catch? Well, this time the IMF has really tried to destigmatize the idea of borrowing from the institution, something that has stuck with it ever since the adoption of the Bretton Woods system. The countries have to meet the same criteria that apply for flexible credit line. The SLL does not have any ex-post conditionality that has often led to the lack of policy sovereignty for borrowing countries. Some of the prerequisites for taking on a loan would be low and stable inflation, a financial system that is not at risk of insolvency, and a sustainable external position. Thus, while 103 countries have approached the IMF for this loan, many of them will not meet all criteria.
But this doesn't mean that they won't get any money. The fact that they won't meet their criteria will mean that they'll have to work towards it in order to get that same amount of money as other countries that have actually met the criteria.
Furthermore, countries that have already been receiving concessional lending from the IMF will not be able to borrow through the short-term liquidity line either. Countries that have greater access to issuing reserve currencies, such as the euro area, will not be counted in either. Although the IMF does not usually grant loan based on income levels of countries, it will predominantly be focusing on helping the emerging economies. Moreover, countries that face a larger balance of payments shock and risk will have to use the FCL instead, since the short-term liquidity line is present solely to address short-term needs. It is possible, however, to switch from one to the other depending on the situation.
Yet, only time will tell if countries actually end up borrowing from the IMF. Requesting to borrow is not the same as being approved and getting the money to your bank account. Considering the IMF's track record, it seems like the numbers are not going to be staggering. The FCL was introduced after the 2008 financial crisis to remove the stigma of taking loans from the IMF, but nothing much had really changed. Until the day today, only three countries have only ever used the FCL. So even after removing so many conditions, countries have always been skeptical of the IMF. Even precautionary and liquidity line, in which the IMF can overlook one or two of the criteria stated in the FCL. Of course, this is largely due to the precautionary and liquidity line's focus on these conditions. The IMF does not admit that previously its borrowing limits were not high enough and that the repayment periods for the countries were too short. And if you've got very strict borrowing limits and very small repayment periods, then the country's not going to be able to pay you back. This was an extra added pressure on countries, and most countries see the IMF as a lender of last resort, but painstakingly avoid using its resources. So this means that we've got an available fund that no one would like to use because it is nearly impossible to give the amount of money that you're being given to give it back in time.
So then, you may be wondering, What routes do countries often take during these routes? Well, domestically, they implement more expansionary fiscal and monetary policies. Moreover, countries also stock up on reserve currencies such as the US dollar. This was done during the 2008 financial crisis and is evident now as the demand for the US dollar has surged, especially amongst the emerging market economies. Another measure countries often take is establishing central liquidity swap lines between domestic and foreign central banks across the world. In the previous crisis, the US Federal Reserve played a key role in providing liquidity and has once more taken on responsibility through its repo program. Both of these methods have been very popular amongst countries because they don't incur high levels of debt. Borrowing from the IMF not only comes with conditionality, but also a burden on the already high government debts. Thus, most countries prefer to provide liquidity in the market through these measures.
The Short-Term Liquidity Line will not only aid the countries, but also help the IMF maintain its relevance. If again, countries rely on themselves or bilateral ties to improve their economies, the role of the IMF would get further diminished in the international community. Apart from its $1 trillion fund, there's really not much of a difference between the IMF and any other think tank that analyzes data and gives policy recommendations to countries. The USA, along with the Federal Reserve, seems to have more say in policy matters lately. The institution definitely needs to step up a notch if it wants to preserve any credibility after the financial crisis has passed. The IMF needs to take action and reshape their reputation.
Thank you guys so very much for watching, and please remember to subscribe, to give us a thumbs up, and to let us know what you think in the comments below. Until next time, always remember, once you see it, you won't help but notice.